Welcome back to Talk Tickers, the essential earnings call breakdown for the serious investor. You know, the one who doesn't have an hour for hold music and safe harbor statements.
It's good to be here.
Today, we are looking at a really interesting and honestly a kind of confusing case study in market psychology. We're dissecting the latest numbers from the railroad giant CSX Corporation.
Yeah, confusing is exactly the right word. I mean, if you just glanced at the headline numbers for CSX's Q4, you'd think it was a total bloodbath.
Right.
But then you look at the ticker after hours and you see green, a lot of green.
That is exactly what I want to unpack.
Yeah.
This feels like a classic numbers versus narrative battle. The headlines were a miss. The industrial environment is subdued, to use their word, and yet the stock rallied. Why?
Well, it's not that investors stopped caring about revenue. It's that they started caring a lot more about discipline. This call wasn't really about the last 3 months. It was about a huge strategic pivot. Management has basically stopped waiting for the economy to bail them out.
And decided to bail themselves out instead. The old self-help plan.
Exactly. Aggressive self-help.
Okay, well, before we get to the cure, let's talk about the symptoms. Walk us through the crime scene. What did the Q4 numbers actually look like?
It was messy. Let's just start with the bottom line. CSX reported GAAP earnings per share of 39 cents.
And the street was looking for what?
The consensus was 41 cents. So that's a 2-cent miss right out of the gate.
Okay, and in this market, a miss like that usually gets punished instantly.
Usually, yeah. And the top line didn't help things. Revenue came in at roughly $3.51 billion, missing the $3.54 billion consensus. That's also down about 1% year over year.
So you've got a company shrinking its sales and missing profit targets. Okay. Based on that, the stock should be down. And it was, right? Initially.
It was. It closed the regular session down about 2%. But then the call starts, the details come out, and you see this complete U-turn. The stock rallied over 3% in after-hours trading.
So what did investors hear that completely changed their minds?
They heard two things: a clean number and a margin miracle. So first, management pointed out that the 39-cent earnings number included a roughly 2-cent hit from severance and technology rationalization.
So, hold on. Technology rationalization? What does that even mean? That sounds like fancy talk for we bought software we're not using anymore.
Well, we're firing the consultants who installed it. Yeah. It's basically one-time costs to streamline the business. If you add that 2 cents back, they hit the 41-cent target.
Okay, so operationally, the market sort of gave them a pass on that, viewed it as the cost of cleaning house.
Exactly.
But just meeting expectations doesn't usually cause a rally. There had to be something else.
And that brings us to the margin miracle. Despite the revenue dropping, their operating margin actually expanded. Operating income was $1.11 billion, and the margin hit 31.6%. That's up 30 basis points year over year.
Okay, let's pause there. For anyone who doesn't live inside a spreadsheet, basis points gets thrown around a lot. 30 basis points is just 0.3%. That sounds like a rounding error. Why does that matter so much?
It sounds tiny, but in a capital-intensive business like railroads, it is huge. It signals leverage. It means that even with less money coming in the door, they got so much more efficient that they kept more profit from every single dollar.
So it's proof of concept. They're proving they can squeeze more out of less.
That's it. And that sets the stage for the main event of this call, which wasn't about Q4 at all. It was about the future.
Right. CEO Steve Angel made a pretty bold move on their long-term targets, didn't he?
He did. This was the big reset moment. He officially withdrew the old 2025 to 2027 targets, said they were built for a different economy, one where industry was actually growing.
You know, I actually respect that. There's nothing worse than a CEO pretending they can hit a number everyone knows is impossible. So they scrapped the fantasy. What's the new reality for 2026?
The new reality is what I'm calling the cash and margin story. They laid out a new framework. First, revenue. They're being super conservative. Low single-digit growth. They're assuming flat industrial production, modest GDP.
So they're not betting on a boom.
Not at all. But, and this is the kicker, they are guiding for an operating margin expansion of plus 200 to plus 300 basis points.
Whoa. Okay, you said 30 was a good signal. 2 to 300. That's 2 to 3% pure margin expansion. How on earth do you do that with a flat top line?
That's the billion-dollar question. And the answer is just aggressive capital discipline. They slashed their capex guidance to below $2.4 billion. And when you combine higher margins with way less spending, you get a massive jump in free cash flow.
How massive?
They expect free cash flow to grow by at least 50% versus 2025.
50%.
50.
Okay, now I get it. Now I see why the stock rallied. In a foggy market like this, investors will pay a huge premium for guaranteed cash flow.
Exactly. You don't have to guess about the Fed or housing starts. You just have to believe they can cut costs.
But that's the execution risk, right?
Yeah.
It's easy to put efficiency on a slide. It's really hard to cut costs on a railroad without, breaking it.
Well, they brought back a heavy hitter. Kevin Boone is back as CFO, and he was talking about over 100 different savings initiatives.
Like, what we're talking, cheaper coffee in the break room?
Yeah.
Or real structural changes?
It's the unglamorous stuff. Cutting consultants, clamping down on overtime, improving asset utilization, getting rid of extra vehicles. He also mentioned headcount is already down 3%.
That's real. That's wages off the books immediately. But speaking of execution, there's a big test coming. Like right now.
Yeah, you can't make this up. Right in the middle of the call, the COO, Mike Corey, had to address a massive winter storm that was bearing down on their network.
The timing is just incredible.
He didn't shy away from it. He mapped it all out. Ice from Nashville to Alabama, heavy snow from Indiana, all the way to the I-95 corridor. This is the heart of their network.
And a year ago, a storm like this would have caused months of problems for them.
Months. Dwell times would spike, customers would be furious. But Corey's message this time was basically, not again. He said the network is resilient, assets are positioned, and he predicted they'd recover by midweek.
That's a very specific promise. He's putting his credibility on the line.
He is. And if they pull it off, it validates this entire self-help thesis. It proves they're running a much tighter ship.
Okay, so the operational machine is tightened up. But they still need to move stuff. What about the commercial side? What's actually selling?
It's a mixed bag for sure, but there is one clear winner. Intermodal.
Okay, for everyone listening, just quickly define intermodal.
It's moving shipping containers, the big metal boxes from ships onto rail cars. Revenue in that segment was up 7% and volume was up 5%. In a freight recession, those are incredible numbers.
And there's a huge catalyst coming for that segment, right? Something about a tunnel in Baltimore.
The Howard Street Tunnel? Yeah. This is the really fascinating part of the long-term story. For decades, this tunnel has been a bottleneck because it's too low. They couldn't run double-stack trains through it.
And double stack is literally stacking one container on top of another.
Exactly. It doubles your capacity for almost zero extra cost. But they couldn't do it into the Port of Baltimore, which made them uncompetitive against trucks. They were fighting with one hand tied behind their back.
But that's changing.
It is. They just finished the first phase. Double stack service starts in Q2 of this year. This is a massive unlock. It lets them compete with long-haul trucking on lanes they could never touch before.
Wow. That's a permanent upgrade to their competitive moat. So if intermodal is the golden child, what's the problem child?
Merchandise and chemicals. Chemicals volume was down 6%, and forest products just fell off a cliff down 11%.
Ouch. Forest products, that's housing and construction.
Pretty much. And the CCO was blunt about it. She said customers are just sitting on their hands controlling spend because of inflation and tariff worries.
Which fits their whole flat guidance. Okay, what about coal? It's the zombie segment that just refuses to die.
It really is. Export coal was down on pricing, but domestic coal, the stuff burned for power in the U.S., was surprisingly strong.
Really? I thought we were shutting down all the coal plants.
We are, but nat gas prices are up, and with data centers and AI, the grid is hungry. So utilities are burning more coal. They even said some plant retirements are being delayed.
So the AI boom is keeping coal trains running. That's ironic.
It is. It just extends the runway for that cash flow.
Fascinating. So let's zoom out. What's the big picture here? The investor context. What about the elephant in the room? All that M&A chatter.
Right. The Union Pacific and Norfolk Southern rumors, management handled it pretty well. They basically said they've been in deal purgatory before, and their focus is 100% on execution. They're not getting distracted.
Smart. Let your competitors get tied up in regulatory hearings while you steal their customers.
That's the plan. And the market is buying it. They're willing to pay for the certainty of margin expansion over the uncertainty of a revenue rebound.
All right, we've covered the past, present, and the future. Now it's time for my favorite part of the show. We are entering the "this is not financial advice" zone.
The disclaimers are on.
Absolutely. We're just reading between the railroad ties.
Yeah.
But based on everything we just heard, the tunnel, the trucking weakness, the margin focus, pitch me a trade. The hedge fund pod analyst pitch.
Okay, I call it the Baltimore double stack spread.
I like it. Sounds professional. What's the trade?
You go long CSX and you go short a basket of pure play trucking stocks.
Long the rail, short the road. Okay, walk me through the logic.
3 things. 1, the moat. That Howard Street tunnel is a game changer starting in Q2. It creates a structural cost advantage over trucks that just didn't exist before on that lane.
So CSX steals market share from trucks on the East Coast. Got it.
2, the macro hedge. Management explicitly said the trucking market remains soft. Too many trucks, not enough freight. It's a brutal price war. CSX is opting out of that war.
So you're betting on the disciplined company against a sector that's cannibalizing itself.
Exactly. And 3, the kicker, the yield. You're getting that 50% free cash flow growth from CSX. You're getting paid to wait while the trucking sector fights for scraps in a flat economy.
I love that. It's a really compelling narrative. You're betting on infrastructure winning over the open road.
Yeah.
And not financial advice, but a very interesting idea.
Absolutely.
So to wrap this all up, CSX misses the quarter, revenue's down, earnings are a little light, but they completely win the narrative war.
They did. They shifted the entire focus to 2026, to that 200 to 300 basis points of margin expansion and that massive jump in free cash flow.
What's the risk here? Where could this blow up?
The risk is if subdued demand turns into a full-blown hard landing recession. Can the self-help cuts hold up if volumes drop another 10%? There's a limit to how much you can cut. If revenue really collapses, the margin story falls apart.
A valid concern. Self-help works best when the patient is stable, not critical. But for now, the market is betting the patient is stable enough.
And that they can handle a snowstorm. We'll see this week.
We will indeed. Check your own charts, ignore the noise, and keep an eye on that Baltimore tunnel. That's it for this deep dive. Thanks for listening to Talk Tickers.
Thanks for having me.
We'll see you next time.